Happy Monday, everybody. Welcome to Liberty Call and the weekly economic update. It is, Monday, February 27th, 2023. Gosh, I look at the date every single time before I get started just to make sure, say it in my head, and I always have to look back up at the screen. So anyways, I hope everyone had a fantastic weekend. My Cougs, woohoo, did pretty good. Who'd they play on Saturday? I forget now. They were... Anyway, doesn't matter. They're still number one, and we got one more week in the college basketball season. I think the Cougs play Tuesday or Wednesday, and then again this weekend, and then the conference tournament starts next week. Then the week after that, we get March Madness for 3 weeks. Woohoo! Then baseball season starts right before the Final Four, which is going to be in Houston. Hopefully the Cougs are going to be in that same Final Four, and the Astros will begin opening their season on Thursday before the Final Four. So anyways, I don't think I'm going to make it down to the game, unfortunately, because we got some stuff going on here in our world with the wife and I, and nothing bad. Everything's great. But we are got some big changes coming up here. So just wanted to talk about that for a second. Anyways, all right. If it's your first time watching, please give me some big old thumbs up, likes, shares, and subscribes. I'd greatly appreciate it. And let's go ahead and jump into the numbers. We got some green on our screen. Hey, you know, after last week's ugly week, we got some green stuff here on the screen. So, all righty. Let's see here. The Dow Jones finished the day up 0.22. Let's see here. The S&P 500 was up 0.32. NASDAQ was up 0.63. Let me go back. Dow closed at 32,889. S&P 500 closed at 3982. NASDAQ closed at 11,466. The VIX fell 3.32% today. It's currently at 2095. Canada was up 0.2. Brazil down 0.1. Mexico up 0.63. Going over to our friends over across the Atlantic, lots of green over there too. Germany up 1.13, UK up 0.72, France up 1.51, Netherlands up 1.42, Spain up 1.23, Italy up 1.7, Switzerland up 0.34, and Portugal up 0.69. Both Russian exchanges were red. MOEX up 1.5, RTSI up 3.41, and the overnights, lots of red. In Japan, the Nikkei was down 0.11, Australia down 1.12. Chinese markets, the Shanghai was down 0.28, the SESE component down 0.72, China A50 down 0.12, DJ Shanghai down 0.34, Hang Seng down 0.26, Taiwan weighted down 0.71. All righty. Oh, let's see here. I forgot to put something up here on my screen real quick. Let me just grab it while sitting here talking to you guys. That's not it. Why is it not on my screen? Anyways, let me bring this up home. Oh, wrong one there too. There we go. Sorry for a second. There we go. All right, just had to get the weekly economic update here on the screen. I forgot to bring it up. All right, let's go ahead and read through this week's weekly economic update. The week on Wall Street, concerns over a firmer monetary policy were heightened by a fresh economic data touching off a climb in bond yields as a slide in stock prices last week. And a slide in stock prices. The Dow Jones Industrial Average skidded 2.99%. The S&P 500 dipped 2.67%. NASDAQ sagged 3.33%. And internationals fell 1.23%. Stock slides. Stock struggled last week, buffeted by growth fears of further Fed tightening and disappointing forecasts from two major retailers that called into question the consumer's health. The release of the minutes from the FOMC last meeting did little to assuage investor worries. Reflecting these concerns of a more aggressive Fed was that by Thursday, traders were pricing in a 27% chance that the Fed might lift rates by a 0.5 percentage point at its next meeting. Yeah, everyone was all happy that we went down to 0.25 percent points or 0.25% changes, and now they're all worried, oh, it might go back up to 0.5%. Boy, this inflation ain't going anywhere until we get it the Fed fund rate above the rate of inflation, and it is just going to be tough. Far above the 1.3% chance just 1 month ago. Stocks took another leg down on Friday following the release of January's personal consumption expenditures price index, which showed hotter than expected price increases and more robust consumer spending. The FOMC minutes from the last FOMC meeting indicated that nearly all members agreed with February's quarter point rate increase, though some would have supported a 50 basis point rate hike to move quicker towards the Fed's target rate. While the minutes suggested another 25 basis point hike is likely at their next meeting, investors remain anxious that more recent economic data may prompt a 0.5% hike instead. The minutes stressed that inflation was still too high. Gee, there's a news flash. However, members diverged on the economy, with some members finding the risk of recession elevated. In contrast, others feel the Fed may engineer a soft landing or avoid recession altogether. Oh, that's funny. Oh, man. These people who work in government and kiss their butts are just some of the dumbest humans on earth. So, well, they will say anything to keep their jobs. I mean, we just have to look at what's going on right now. I mean, there was a Wall Street Journal article that came out over the weekend that said, the Fauci flu started in China. No, really? Like, I didn't know that 3 years ago. All you have to do is go to the conspiracy thread on Reddit. They would have told you that three years ago at this time. Anyways, all right, economic data coming out this week. On Monday, we got durable goods orders, which is today. Tuesday, we have consumer confidence. Wednesday, the ISM manufacturing index. Thursday, we have jobless claims. Friday, the Institute for Supply Management Services index. Companies reporting earnings this week. Today, on Monday, we have Workday. Tuesday, we have Occidental Petroleum, or Oxy as they like to call it in Houston. Target Corporation, AutoZone, Ross, and Agilent Technologies. Wednesday is Salesforce, Lowe's, and Dollar Tree. Thursday, we have Broadcom, Costco, Best Buy, Marvel Technology, and Dell Technology. All right, well, that's everything for the weekly update. Let's go ahead and jump over into the today's market recap. Here it is. SP 500 climbs as dip buyers pile into growth stocks following a recent rout. Let me get my notes up here. Here we are. Okay. The SP 500 climbed on Monday, attempting to recover from its worst week of the year as dip buyers scooped up growth stocks, including tech, despite persisting fears about a more hawkish Federal Reserve. So these people buying the dip might get their butts handed to them if, because they're thinking, hey, everything dropped a bunch last week. Let me go in and scoop up a bunch of good values because the market's going to go back up because the Fed's going to be on our side. They're going to slash interest rates and do a bunch of QE here in the future. So I'm going to go ahead and buy real cheap. Market goes up, then I'll sell it off, after the Fed's done what they do. I don't think the Fed's going to have any room to be able to cut rates anytime soon. So these people might be making a bad decision. Tesla led gains in the consumer discretionary sector ahead of its investor day on Wednesday, where it's expected to present its longer-term growth strategy, including the introduction of the Master Plan 3 and its third-generation vehicle platform, which could support multiple future vehicles and segments at a lower price point. Fisker surged 30% on unchanged vehicle production guidance for 23, despite quarterly results that were worse than feared. Tech stocks also saw an uptick in demand as Apple, Microsoft, and Alphabet traded positively. Meta Platforms was the exception, trading just below the flat line. Despite the somewhat flawed launch of its AI chatbot Bard, Google download activity remained stable, and Bank of America said it was unaware of any slowing in Google search revenues that could be attributed to the late 2022 ChatGPT launch. Growth stocks were supported by easing Treasury yields following a surge in recent weeks amid concerns about higher Fed rate hikes. Economic data showed that durable goods fell more than expected, but a deeper dive into the details suggested ongoing strength in the economy. Business investment improved somewhat at the start of the year, adding to the list of indicators painting the U.S. economy as steady. In deal news, Pfizer reportedly began early talks to acquire cancer drug maker Seagen. Such a move would provide a much-needed boost to Pfizer's oncology business. Seagen jumped more than 10%. Yeah, I don't know if I have much faith in any of these pharmaceutical companies. They are crooks and criminals, in my opinion. But hey, that's just one guy's opinion. All right, next up comes from our friends over at Zero Hedge. The next bear market shoe is about to drop. Ooh, let's see what they have to say here. The analogy of a dog walking on a leash with a man through the woods is used to describe investor sentiment in equity markets. The man represents the fundamentals of the market, while the dog represents investor behavior and market valuation. The dog may stray side to side, chasing woodland creatures and trying to smell items. Hey, sounds like my dog. But it always winds up walking down the path in the same direction as the owner, as the fundamentals continue to dictate the long-term course. The writer believes that equity markets are overpriced and will eventually suffer under 5% interest rates, persistent inflation, and a debt-strapped consumer, and depleted savings. The market was down about 3% last week, but is still up 3.4% for the year. He believes that despite not being proven immediately right on a number of predictions, the market remains on the same path. The author also mentions that respected individuals like his friend Kenny Polcari believe that interest rate hikes are not going to pause or pivot anytime soon, and that rates could possibly go to 6%. Hey, who's been saying that? This dude right here. I've been saying that for months. The author believes that the market has not yet digested the full effects of rate hikes that has already happened, and it hasn't prepared itself for future rate hikes or holding the funds rate where it is right now for longer. He also mentions that the bond market appears to be in the midst of a historic panic attack, and that reversion to the mean is coming. If the market stays on path, there will be a tipping point where consumers are simply tapped out and market valuations are forced to contract as a result of less spending, and also eventually shift into market psychology. He concludes that the market is up this year while the Fed has done nothing but hike rates and allow inflation to run rampant. And it's simply a dog that has wandered off the path towards euphoria, optimism, and bullishness despite the underlying direction of the economic path it'll be forced to travel down. All right. Pretty good stuff there. All right. So basically, kind of just to, summarize that is, when you're walking your dog on a leash, he goes all over the place. And well, when I walk my dogs, typically when I'm out here in the right next to the front range, I got a lot of open land and I just take him off the leash and let him run all over the place. But, he always comes back to me because where's the food? Right here. He's got to come home with me if he wants to eat dinner and sit on a nice couch and get scratches behind the ears. So anyways. All right, last up comes from our friends over at First Trust, Brian Westbury, their chief economist. It's titled Hard Landing, Soft Landing, or No Landing. All right. Recently, a group of economists and investors have put forward the argument that the U.S. economy will not experience a hard or soft landing, but will instead reaccelerate and do just fine. These people, they make me laugh. Oh, yeah, it's going to crash and burn. They suggest that at the bottom of the bear market was in October of 21 and that the bear market is likely already over. Boy, could have fooled me. Normally bear markets, when they've been over for over 12 months, markets are going up. They're not going down in those situations. Wow. However, this is a very optimistic view of recent economic reports. While consumer spending in January was reported as strong, it was likely due to unusually warm weather and the policy response to COVID, which has made seasonal adjustments difficult. Inflation remains a major problem, with the consumer price index up 6.4% from a year ago, and super core PCE prices up 7.4% in January, the fastest increase for any month since 2021. The Federal Reserve is not satisfied with the progress on inflation and is likely to continue hiking short-term interest rates until there is more evidence of inflation coming back down towards 2%. Meanwhile, the economic stimulus provided the government checks and loose monetary policy is wearing off. The money supply measure of M2 has hit a wall and declined during the past year by the most for any year since the Great Depression. The yield curve is steeply inverted, and risk aversion among investors and in corporate America is likely to increase. This should pose a big headwind for GDP growth later this year, with prolonged weakness in business investment and equipment and commercial construction. Low employment and recent job growth are not sufficient to prevent a recession. The labor market is a lagging indicator. Who has been saying this for months? I've been saying this and saying this and saying this. And my friend Brian Westbury, who I've only met like once or twice, and he probably wouldn't remember me at all because he came down to Houston a bunch of times or at different times and did his when First Trust goes around from city to city. Very nice guy. Now, he could be a complete jerk behind the scenes, but in my interactions with him and listening to him speak on dozens of occasions, either through webcasts or in person, Super nice dude. Knows his stuff. Anyways. All right. Where was I? Lagging indicator of economic performance and job growth and wages are likely to slow. This means tepid gains in consumer purchasing power at the same time as low-income households have run out of stimulus-induced savings. None of the recent reports has changed the forecast of a recession. Given the Fed's reaction function and the decline of M2 that has already happened, if there is more growth than expected in the near term, there will be more pain later when the recession hits. In conclusion, while some economists and investors have suggested that the U.S. economy will reaccelerate and do just fine. Again, it just makes me giggle. This is a very optimistic view of recent economic reports. Inflation remains a major problem, and the economic stimulus provided by government checks and loose monetary policy is wearing off. Low unemployment and recent job growth are not sufficient to prevent a recession, and none of the recent reports has changed the forecast of a recession. If there is more growth than expected in the near term, this, again, will result in more pain. So, all right. Well, that's everything I had for today. I hope this was entertaining for everyone out there. If you need anything from me, please go to dsafinancialgroup.com. All my contact information is there. Hope everyone has a fantastical evening, and I will talk to you guys next time. Adios.